Welcome to the deep dive. Today, we're putting one of the real veterans of the tech world under the microscope, NetApp Inc., ticker NTAP.
Right.
For, 30 years, they were known mostly as an enterprise storage giant, the folks selling the hardware boxes.
The classic model.
Exactly. But now, in this era where AI is just exploding and public cloud is king, the big question is simple. Has this, mature company actually managed to pull off a successful reinvention?
And maybe more importantly, if they have, why does Wall Street still seem to be treating them like they're stuck in the past?
That's the puzzle, isn't it?
It really is. It's a fascinating disconnect. We're looking at a company that seems to have made a really smart strategic pivot, away from what looked like an existential threat. Yet the market seems, hesitant to give them full credit. As of September 19th, 2025, the stock closed at $125.69.
Okay.
Our own analysis, looking at intrinsic value, suggests maybe a target a bit higher, around $131.59.
So a little upside there.
A little, yeah. We think the underlying story, especially around their unique cloud strategy, is actually quite strong. But, market inertia, it's a powerful thing.
So our mission today, for you, the learner, is really to unpack the evidence.
Right.
What supports that value, and figure out what exactly Wall Street might be missing here.
Precisely. And just to ground us, all the data we're discussing today is anchored to that $125.16 closing price from September 19th, 2025.
Got it. Okay, let's dig in. We've set the stage. Reinvention versus market inertia. But how deep does this transformation actually go? Let's start with the basics, the nature of the business itself. Chapter 1, Business Understanding.
Exactly. And the biggest shift here is really one of identity. NetApp isn't pitching itself as just a hardware box seller anymore.
Right.
They now define themselves as an intelligent data infrastructure company. That sounds a bit buzzwordy, I know, but it signals a shift towards managing data wherever it lives, not just, housing it on-prem.
Okay, intelligent data infrastructure. But that can sound like marketing speak until you look at the numbers. What's the hard proof that this isn't just talk?
I think the clearest evidence comes from their revenue mix in fiscal year 2025. This is kind of the smoking gun.
Right.
54%. Over half their revenue now comes from services, that's software, support, and their cloud offerings.
Wow, 54%.
Versus only 46% from traditional product sales, the hardware. That shift fundamentally changes their business profile, moving them towards those more predictable, recurring revenues that, software companies tend to enjoy.
That's a huge shift for a company with a 30-year hardware legacy. Now, let's break down their main segments. The hybrid cloud segment, that's still kind of the bedrock, right? Anchored by their ONTAP operating system.
ONTAP is absolutely key. It's the data management software that runs across their portfolio, and it's used by something like 85% of Fortune 500 companies.
85%?
Yeah, it creates enormous switching costs. People build their workflows around it. And even within that hybrid space, on the hardware side, they're not just selling any old boxes. They actually hold the #1 market share position in all flash storage.
Okay, so they dominate the high-growth, high-performance end of storage hardware.
Exactly. They didn't just abandon hardware. They focused on the most valuable part of it.
But here's where it gets, I think, really compelling. The public cloud segment. This feels like the engine driving the whole reinvention narrative.
This is their strategic differentiator, their moat, if you will. They aren't just selling software for the cloud. Their services are actually co-engineered and natively embedded within the big three: AWS, Microsoft Azure, and Google Cloud.
Co-engineered. What does that actually mean in practice?
It means NetApp's storage services appear as if they are native services offered directly by AWS or Azure or Google Cloud. They're deeply integrated. So for many enterprises using these hyperscalers, they might actually be using NetApp technology without even realizing it, or it's just the easiest, most integrated option.
That's a powerful position. I remember seeing an IDC quote calling NetApp the only storage vendor that has co-engineered native first-party services with the major public cloud providers.
That's the one. And think about the strategic implication. It transforms these giant cloud providers from potentially existential competitors, which they definitely looked like maybe 6-7 years ago.
Right, they could have just crushed them.
Into powerful sales channels. They're now partners, driving NetApp consumption. It's a brilliant strategic jujitsu move.
So they're selling simplification, really. A single way to manage data, whether it's on-prem or spread across multiple clouds.
Precisely. They offer that siloless approach. Enterprises are drowning in data complexity, especially with AI and IoT generating even more. NetApp steps in as the manager for that whole estate.
And there's a security angle too, right? Something about top secret data.
Yeah, this is a significant differentiator. NetApp is apparently the only vendor validated to store top-secret classified data according to the NSA's CSFC component list. That level of third-party security validation gives huge comfort to large, security-conscious enterprises and government agencies. It's hard to overstate that advantage.
And the broader market trends seem tailor-made for this strategy. You've got the global cloud storage market projected to grow at, what, over 20% compound annual growth rate?
21.7% CAGR, fueled by all that AI data. Plus, surveys show something like 92% of companies plan to use a multi-cloud strategy by 2025.
So the more fragmented the data landscape becomes, the more valuable NetApp's unified management potentially is.
That's the thesis.
Okay, that paints a compelling picture of the business pivot. Let's move to Chapter 2, Management Evaluation. How do they actually pull this off? It sounds complex.
A lot of credit has to go to the leadership, particularly CEO George Kurian. He's been in the role since 2015.
Right, so he oversaw this entire strategic shift.
His tenure is pretty much defined by navigating away from that potential public cloud iceberg and steering towards partnership instead. But it wasn't just internal strategy. Shrewd M&A played a big part.
Buying the future, essentially.
Kind of, yeah. They used acquisitions strategically to accelerate the move to cloud. Key examples would be Spot, which they bought in 2020.
Spot, what do they do?
CloudOps. They specialize in optimizing cloud compute costs. So a really nice complement to NetApp's storage focus, helping customers manage the entire cloud bill.
Makes sense. Any others?
InstaCluster in 2022 was another important one, focused on cloud-native applications and databases. Again, deepening their cloud capabilities through acquisition.
Okay, but I want to push back a bit here. NetApp comes from a hardware culture, right? Buying these fast-moving, maybe more agile software and CloudOps companies like Spot. Isn't there a big integration risk? Culture clash.
That's always a risk with M&A, absolutely. But the financial performance we'll get into suggests they've managed it reasonably well so far. And a key reason they can make these acquisitions without, breaking the bank or stressing the core business is what they call their dual-engine capital strategy.
Dual engine. Explain that.
Management has an explicit goal: return up to 100% of free cash flow to shareholders. And they're serious about it. In fiscal year 2025 alone, they returned a huge $1.57 billion through dividends and share buybacks.
$1.57 billion. So it sounds like they view the established, mature hybrid cloud business as basically a giant cash cow.
That's exactly the interpretation. The traditional storage business, while maybe not growing explosively, generates very reliable, very strong cash flow. And that cash fuels two things at once: those generous shareholder returns, which keeps value investors happy.
Right.
And it funds the strategic M&A needed to buy those future growth technologies in the cloud space. The cash cow feeds the innovation engine. It's quite elegant, actually.
And is this capital allocation efficient? Are they getting good returns on these investments?
The numbers suggest yes. Their trailing 12-month return on invested capital, the ROIC, is sitting at a very healthy 21.47%.
Okay, 21.47%. How does that compare?
Well, you compare it against their cost of capital. Their weighted average cost of capital, or WACC, is estimated at 9.58%.
So ROIC is more than double the WACC.
Exactly. When your return on capital is that much higher than your cost of capital, it's a strong sign that management is effectively creating economic value with the money they're deploying. The strategy isn't just talk. It seems to be working financially.
Okay, that leads us nicely into the underlying numbers. Let's turn to Chapter 3, Financial Analysis. What else does the balance sheet tell us?
Well, first, the profitability metrics really stand out and support that shift away from just low-margin hardware. The trailing 12-month gross margin is 70%.
70%. That's software territory.
It really is. And the net margin is also strong at 17.77%. This suggests they have real pricing power, likely from that specialized NTAP software and their integrated cloud services. They're not just competing on price for hardware anymore.
And the cash flow, you mentioned it's strong.
It's very consistent. They're a reliable free cash flow machine, typically generating over $1 billion a year. For fiscal year 2025, it was $1.34 billion.
Okay, solid cash generation.
Sure.
But this brings us to something you flagged earlier, a potential aha moment for you, the learner. It's about share buybacks and a scary-looking metric.
Right. If you just glance at their balance sheet, the reported debt-to-equity ratio is alarming. It's 9.41.
9.4. That sounds incredibly high. Like dangerously leveraged.
On the surface, yes, it looks like a massive red flag. But you absolutely have to understand the why. This high ratio is not because the company is drowning in operational debt or facing distress.
Okay.
It's a direct and actually deliberate consequence of those massive share buybacks we just discussed.
How do buybacks inflate debt to equity?
When a company buys back its own stock, that stock is removed from the market and held as treasury stock, which reduces the shareholder equity figure on the balance sheet that's the denominator in the DE ratio.
Ah, so the equity part shrinks dramatically because of buybacks.
Exactly, which mathematically makes the debt-to-equity ratio shoot up even if the actual debt level hasn't changed much or is perfectly manageable. You have to look at their liquidity, too. The current ratio is 1.31, which is healthy. It indicates they can cover their short-term obligations.
So the scary DE ratio isn't really about operational risk. It's more a result of financial engineering aimed at boosting shareholder value through buybacks.
Precisely. It's a strategic choice enabled by strong cash flow, not a sign of weakness. Understanding that context is critical.
Okay, that's a really important clarification. Now, what about valuation? How does the market value this transformed NetApp? You mentioned the PE ratio.
Yeah, the trailing 12-month PE ratio is currently 22.3x.
22 times earnings. How does that stack up against peers?
Well, it needs context. It's definitely higher than a more traditional hardware-focused competitor like Dell, which trades around, say, 16.8x PE.
Okay.
But it's way, way lower than a high-growth, primarily software and storage innovator like Pure Storage. Pure Storage trades at a PE over 200x.
Whoa, okay, huge difference.
Right. And that PE gap is really the core of the investment thesis here. Meaning it suggests the market is still applying a kind of blended multiple to NetApp, heavily influenced by its legacy hardware business, maybe seeing it as partly hardware, partly software.
Even though that public cloud segment, the software and services part, is growing at 33% year over year.
Exactly. That segment is growing like a pure play software company, but the overall company multiple doesn't reflect that yet.
So the potential opportunity is for a re-rating. The market eventually realizing the cloud growth deserves a higher multiple for the whole company.
That's the bull case in a nutshell. If that cloud segment continues its trajectory and becomes an even larger part of the business, it might become too significant for Wall Street to ignore, potentially leading them to apply a higher, more software-like multiple, say, closer to 30x instead of 22x to the entire enterprise. That's where the upside could come from.
Okay, interesting. Let's shift now to Chapter 4, market sentiment, and then we'll touch on Chapter 5, ownership structure. What's the current vibe from Wall Street analysts?
It's decidedly lukewarm, actually. The consensus rating is basically a hold. You've got 7 analysts with buy ratings, but 10 are sitting on the fence with hold ratings.
So more holds than buys. They're not fully convinced yet.
Seems like it. And the average 12-month price target from these analysts is only $124.07.
Huh. That's actually slightly below the current price of $125.16 we mentioned.
Yeah, it suggests analysts might be anchored to the past performance, maybe modeling based on the slower growth of the legacy hybrid business, and not fully factoring in the potential acceleration from the cloud segment. There seems to be a disconnect between the strategic execution we've discussed and the analyst consensus.
But what about the stock price itself? Is it showing any conviction? What are the technicals saying?
Technically, the picture looks stronger. The stock has good momentum. It's trading comfortably above both its 50-day moving average, which is around $111.22, and its 200-day moving average at $106.91.
Okay, so trading well above key support levels. That's generally seen as bullish, right?
Generally, yes. That gap between the current price and the moving averages signals positive momentum, even if the fundamental analyst ratings are cautious. It suggests traders, or the market mechanism itself, might be sensing something positive.
Any signs of significant bearish sentiment? What about short interest?
It's moderate. Short interest is sitting around 5.09%. Not extremely high, but not negligible either. It indicates some level of skepticism out there.
Okay, so a mixed picture from the market signals. Now, who actually owns NetApp stock? Let's quickly cover Chapter 5, ownership structure.
This is quite striking. Institutional ownership is incredibly high, 98.3%.
Wow. Almost entirely owned by big institutions.
Pretty much. Think Vanguard, BlackRock, the usual large asset managers. They dominate the shareholder list.
What does that tell us? What are the implications of such high institutional ownership for, someone listening to this?
Well, on the one hand, it provides a degree of price stability. These large funds tend to be longer-term holders. But on the other hand, it suggests that the main discovery phase, where large institutions first identify and buy into a promising company, is probably over for NetApp.
So future price appreciation isn't likely to come from big funds suddenly discovering it.
Less likely, yeah. It would probably require either that fundamental re-rating we talked about, the market deciding it's worth a higher multiple, or the existing institutional holders increasing their conviction and adding significantly to their positions. The big players are already in, now they need a reason to buy more.
And what about insiders? Management ownership?
It's very low, actually. Only about 0.389%.
Less than 0.5%.
Yeah, it reinforces that image of NetApp as a mature, blue-chip, professionally managed company, rather than, say, a founder-led growth story where insiders own a huge chunk.
Okay, we've laid out the business, the management, the financials, the market view. Now we have to address the potential pitfalls. Let's move to Chapter 6, Risk Assessment. What could go wrong here?
Well, internally, one thing to watch is customer concentration risk. About 45% of their revenue comes through just two main distributors, Arrow and TD SYNNEX.
45% through two partners. That does sound like a vulnerability if anything happened with one of them.
It is a concentration risk, definitely. But perhaps the more significant threats right now are external macroeconomic ones. I think of it as a potential pincer movement that could really squeeze NetApp.
A pincer movement. Okay, explain that.
It comes from two directions: high inflation and interest rates on one side, and potential geopolitical issues like tariffs on the other. And critically, both prongs of this pincer threaten the cash cow part of NetApp's strategy.
They hit the hybrid cloud business, the part generating the cash needed for the cloud pivot.
Exactly. Remember, that whole dual-engine strategy relies on steady, strong free cash flow from the established on-premises and hybrid business.
So how does the first part of the pincer high rates hurt that?
High inflation and rising interest rates increase the cost of capital for NetApp's enterprise customers. These customers typically refresh their big storage hardware infrastructure, a major capital expenditure, or CapEx, every few years.
Right.
But when money is expensive, when borrowing costs are high, companies get cautious. They might decide to delay that big hardware refresh, maybe push it out an extra year or two to save cash.
And that directly hits NetApp's predictable hardware revenue stream from the hybrid cloud segment. It starves the cash cow.
Precisely. It slows down that engine just when they need it humming.
Okay, that's one side of the pincer. What's the other? Geopolitics and tariffs.
Yeah, there's been talk, for example, of potential new tariffs in 2025 on technology imports, particularly components coming from certain regions. Since NetApp still has a significant hardware component to its business, tariffs like that could directly increase the cost of the components they use to build their storage systems.
Which forces them into a tough choice.
Exactly. They either have to absorb those higher costs, which shrinks the profit margins on their hardware again, hurting the cash cow, or they have to pass those costs onto customers by raising prices.
But raising prices could dampen demand, especially if customers are already hesitant due to high interest rates.
That's the squeeze. High rates reduce demand, and tariffs increase costs or force price hikes that further reduce demand. It's a nasty combination that could potentially undermine the funding mechanism for their crucial cloud transformation. That's the core macroeconomic risk here.
And we shouldn't forget simple competition either, right?
Absolutely not. They face intense competition from all angles. You've got the traditional IT giants like Dell and HPE still competing hard in the hybrid space. You have modern, fast-growing innovators like Pure Storage focused purely on flash and software. And ironically, even their own hyperscaler partners, AWS, Azure, Google, offer competing storage services directly. It's a tough neighborhood.
Okay, brings us to the end. Let's wrap this up with Chapter 7, Conclusion and Outlook. Can you synthesize the bull and bear arguments for us?
Sure. The bull case really hinges on their dominant market leadership in key areas like all-flash storage, the clear success of their strategic pivot towards cloud evidenced by that 30% plus cloud segment growth.
Right.
Their unique competitive moat created by that deep co-engineering with the hyperscalers, and the company's proven ability to generate strong free cash flow and return a lot of it to shareholders.
A solid bull case based on execution and strategy. And the bear case.
The bear case focuses on the intense competition from multiple directions, the company's high sensitivity to macroeconomic conditions, particularly those CapEx cycles affecting their core hardware business, and the specific vulnerability of that hardware business to potential geopolitical disruptions like tariffs.
So where does that leave us with valuation? You mentioned your DCF model earlier.
Yeah, based on our educational discounted cash flow model, we arrived at an estimated intrinsic value of $131.59 per share.
Okay, $131.59. And the market price currently is $125.16.
Right. So the current market price seems to be doing a reasonably fair job of balancing things. It acknowledges the undeniable success of NetApp's strategic pivot and their cloud momentum, but it's also pricing in a discount for those very real and significant macroeconomic risks hanging over the hardware foundation, the cash cow.
So the market sees the progress, but remains cautious about the potential headwinds.
That seems to be the most likely interpretation of the current price. It's giving credit, but not getting overly exuberant given the global economic uncertainty and its specific impact on NetApp's funding engine.
Okay, so since the market seems kind of stuck on that blended PE multiple, influenced heavily by the legacy business, that 22x number, maybe the real question for you, the learner, to ponder is this. How big does that fast-growing cloud segment, the one expanding at 33% year over year, need to become as a percentage of the total business before Wall Street finally throws in the towel on the old multiple and gives the entire stock a higher, more software-centric valuation? That's the key thing to watch, isn't it?
That's exactly the inflection point investors are likely waiting for.
All right. If you found this deep dive valuable, please do remember to like and subscribe to Stock Analytics AI. We'd really appreciate it. And for our members, it's just $4.99 a month. You get priority access to deep dives like this one. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get first dibs on those analyses.
And if you just want a specific company covered, dropping us a super thanks is a great way to request a one-off deep dive.
Absolutely. Finally, the important bit we always have to say. This analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.